Are you tired of feeling lost and confused when it comes to investing? Are you ready to take control of your financial future and start achieving your financial goals? If so, then you are in the right place. Today, I am going to introduce you to a book that has the power to change your life, just like it did mine. I am talking about The Intelligent Investor by Benjamin Graham. Now, I know you might be thinking, just another investing book, why should I care? But let me tell you, this is not just any ordinary book. It's a classic, a masterpiece, a must-read for anyone who wants to be successful in investing. It opened my eyes to the world of investing and helped me understand the principles of value investing that have helped me achieve financial freedom. The author, Benjamin Graham, is considered the father of value investing and has had a huge influence on many successful investors such as Warren Buffett. And when Warren Buffett endorses a book, you know it's worth reading. Whether you're a beginner or an experienced investor, this book has something for everyone. So, are you ready to unlock the secrets to successful investing and take control of your financial future? Join me as we dive into the world of the intelligent investor and discover how this book can change your life. 1. Conduct thorough research and analysis when making investment decisions. Before making an investment, conduct in-depth research and analysis of a company's financial statements, industry and competition, and management. This includes analyzing the company's balance sheet, income statement, and cash flow statement to understand its financial health, researching the industry and competition to understand the company's position in the market and its potential for future growth, and evaluating the company's management and performance. For example, you can use tools like financial ratio analysis to gain insight into a company's financial performance, and read industry reports to understand the market trends and competition. 2. Focus on the long-term potential of a company. Instead of being swayed by short-term market fluctuations, focus on the long-term potential of a company by looking at its fundamentals such as earnings, revenue, and growth prospects. By focusing on the long term, you can identify companies with a strong foundation and potential for growth, and avoid being swayed by short-term market fluctuations that may not reflect the company's actual performance. For example, you can use techniques like discounted cash flow, DCF, analysis to estimate a company's intrinsic value and compare it to its current market price, to identify undervalued stocks with long-term potential. 3. Diversify your portfolio to minimize risk. Diversify your portfolio by investing in different types of stocks, bonds, and real estate to minimize risk and maximize returns. By spreading your investments across different types of assets, you can minimize the impact of any potential losses from one investment, and also spread out your risk across different industries and sectors. For example, you can invest in a mix of blue-chip stocks, bonds, and real estate to diversify your portfolio and minimize the impact of any market fluctuations or economic downturns on your overall portfolio. Additionally, you can also diversify your portfolio by investing in different geographies. This way you can reduce the impact of any specific country or region's economic or political issues on your portfolio. 4. Maintain a margin of safety to protect against potential losses. The margin of safety is a cushion that protects investors from potential losses by buying assets at a price below their intrinsic value. By maintaining a margin of safety, you can ensure that you're not overpaying for a stock and that you have a buffer in case the stock's price drops. For example, you can use the margin of safety principle to buy a stock at a price that is below its intrinsic value, which can act as a buffer against potential losses. Additionally, you can use tools like price-to-earnings ratio, PE ratio, to identify companies with a low PE ratio, which can indicate that they are undervalued and have a margin of safety. 5. Understand the concept of Mr. Market and take advantage of market mood swings by buying low and selling high. By understanding the concept of Mr. Market, a fictional character that represents the emotions and irrationality of the stock market, you can take advantage of market mood swings by buying low and selling high. For example, when the market is in a downturn, you can use this opportunity to buy undervalued stocks that have long-term potential and sell when the market recovers and the stock's price increases. Additionally, by understanding the concept of Mr. Market, you can also develop a contrarian investment strategy that goes against the market trend, which can help you identify undervalued stocks with long-term potential. 6. Don't be swayed by market trends or popular opinion. Stick to your own research and analysis. One of the key takeaways from the book is the importance of conducting your own research and analysis when making investment decisions. Benjamin Graham emphasizes the importance of not being swayed by market trends or popular opinion, and instead sticking to your own research and analysis. By doing so, you can make investment decisions that are more likely to be successful. For example, instead of following the hype of a popular stock, you can conduct your own research and analysis of the company's fundamentals, financial position, and management to make a more informed decision. Additionally, by relying on your own research and analysis, you can also avoid the trap of following the crowd and making impulsive decisions based on emotions or hype. 7. Understand the difference between investing and speculating. Another important concept introduced in the book is the difference between investing and speculating. Investing is the process of making informed decisions based on research and analysis, whereas speculating is making decisions based on emotions or guesses. By understanding the difference between investing and speculating, you can avoid making impulsive decisions that are more likely to be unsuccessful. For example, instead of buying a stock based on a hot tip or a rumor, you can conduct your own research and analysis of the company's fundamentals, financial position, and management to make a more informed decision. 8. Look for companies with a strong financial position. The book also emphasizes the importance of looking for companies with a strong financial position. This includes looking at factors such as the company's liquidity, debt-to-equity ratio, and earnings history. By looking for companies with a strong financial position, you can identify companies that are more likely to be successful and have a lower risk of default or bankruptcy. For example, you can use financial ratios like current ratio and debt-to-equity ratio to gauge a company's liquidity and debt level, and also look at its earnings history to understand its financial performance over time. 9. Consider the management and leadership of the company. Another important factor to consider when making investment decisions is the management and leadership of the company. By understanding the company's management and leadership, you can identify companies with a strong vision and strategy for growth, as well as those that are managed by experienced and capable leaders. Additionally, by evaluating the company's management and leadership, you can also identify any red flags such as poor management decisions, insider trading, or lack of transparency. For example, you can look at the company's management team's track record, their experience, and also assess their communication and transparency with shareholders. 10. Be patient and disciplined in your approach. The final takeaway from the book is the importance of being patient and disciplined in your approach to investing. Benjamin Graham emphasizes the importance of sticking to your investment strategy and avoiding impulsive decisions. By being patient and disciplined, you can avoid the emotional rollercoaster of the stock market and instead focus on the long-term potential of the company. For example, instead of selling a stock after a short-term price drop, you can stick to your investment strategy and hold onto the stock if it is still fundamentally sound and has long-term growth potential. Additionally, by being patient and disciplined, you can also avoid the trap of chasing after short-term gains and instead focus on building a diversified portfolio of strong companies that have long-term potential. Furthermore, by being patient and disciplined, you can also avoid the common mistakes that investors make by buying high and selling low, and instead, focus on the long-term potential of the company. Therefore, by being patient and disciplined in your approach, you can make more informed and calculated investment decisions that are more likely to yield positive results. Thank you for watching our video on The Intelligent Investor by Benjamin Graham. We hope that you found the information shared in the video to be helpful and that you feel more confident in your ability to make informed and calculated investment decisions. Remember, the strategies and techniques outlined in the book can be applied to a variety of situations and can help you achieve your financial goals and improve your long-term wealth. The Intelligent Investor is a valuable resource for anyone looking to create lasting financial change and build a strong investment portfolio. So if you're ready to take control of your finances and make positive changes to your financial future, give this book a read. We hope you found this video to be helpful and we look forward to seeing you in our next video. Thanks for watching.